Something extraordinary just happened. Something that changes everything. Silver closed today at $79.25. That's a 10% gain in one single trading day. This isn't a normal rally. This isn't a squeeze. This is a liquidation event, the sound of a financial system breaking in real time. For years, we've talked about artificial price suppression in precious metals, about paper manipulation schemes, about concentrated short positions held by bullion banks. We warned that when this system finally breaks, it won't crack slowly, it will shatter violently. Today, that shattering began. When a market moves 10% in one session, normal price discovery has ceased. Buyers and sellers aren't negotiating. Instead, clearing engines are liquidating massive positions at whatever price necessary. Desperate short sellers are being forced to cover at catastrophic prices. This is vertical price action, the signature of forced capitulation through extreme buying pressure. And if you think today's move is dramatic, understand this. Monday's opening could make today look tame by comparison. The liquidation cascade under normal conditions, markets are continuous negotiation. Buyers bid, sellers ask, prices move gradually, but 10% in one day, that's not negotiation. That's forced liquidation. Here's what happened. A trading desk holds 10,000 short contracts, 50 million ounces of silver promised at $60. When price hits 79, they're down nearly $1 billion. The clearinghouse doesn't care about fairness. It cares about system integrity. When losses exceed margin, it issues an ultimatum: deposit cash immediately or we liquidate your position. Most can't deposit hundreds of millions on short notice. So the clearinghouse starts buying, forcing purchases that push prices higher, which triggers more margin calls, which forces more buying, which drives prices higher still. This is the cascade. Forced buying creates conditions for more forced buying. Once it begins, it doesn't stop until every underwater position is liquidated or prices reach levels where sellers emerge. Today's move tells us we're deep in this liquidation phase. More is coming. The macro context: silver isn't moving in isolation. Gold recently traded around $4,500 per ounce. Gold has been rising, driven by loss of confidence in fiat currencies. When central banks print trillions, when government debt reaches wartime levels, when inflation exceeds targets, people flee to real assets. Gold captured that flow first. Now silver is catching up with ferocious speed. The gold-to-silver ratio currently sits around 57. Historically, it averages 40 to 60. During silver strength, it drops to 20 or 15. Automated trading algorithms recognize this disparity. They're programmed to buy undervalued assets relative to correlated ones. Right now, those algorithms are snapping up massive silver quantities, accelerating the convergence. This is mathematical rebalancing enforced by machines. The weekend crisis: here's what makes today dangerous: timing. We're entering one of the thinnest liquidity periods of the year. Holiday schedules, reduced staffing, banks operating with skeleton crews. A 10% move during high liquidity would be concerning. During thin liquidity, catastrophic. And now we face a weekend with markets closed while implications sink in globally. Right now, risk managers are receiving emergency calls. CFOs are being briefed on potential losses. Clearinghouses are calculating exposure. By Monday morning, two things will happen. First, everyone will know the scale of disaster, which institutions are underwater, which clearinghouses are overextended. Second, retail investors will wake up to headlines about silver's historic surge. Millions who've never owned silver will suddenly want to buy. When markets reopen Monday, institutional panic and retail FOMO collide on an already strained system. The result? Gap openings so large they might trigger circuit breakers designed to halt trading during extreme volatility. Industrial panic: while financial traders fight over paper contracts, industrial companies face crisis. Tesla, Samsung, solar manufacturers, they use massive silver quantities. They relied on predictable supply and stable pricing through futures contracts. Today's move shattered that confidence. When futures surge 10% in a day, industrial hedges collapse. Supply chain managers face an impossible choice: pay whatever price demanded or halt production lines costing millions per hour. They'll pay. They have no choice. This creates a new buyer class: industrial users forced to transition from paper hedging to physical purchasing. Their demand is inelastic. They're not speculating, they're securing materials for operations. Reports suggest major manufacturers are offering significant premiums above spot price for guaranteed delivery. 79 on the screen. Some industrial buyers allegedly pay 85 or 90 for next week delivery. This industrial buying isn't temporary panic, it's permanent shift. Once companies realize futures can't guarantee delivery during crisis, they'll maintain larger physical inventories indefinitely. That's structural demand removal from available supply. Clearinghouse threat. Today's move threatens the entire futures trading system. Clearinghouses guarantee every trade. They operate with risk models based on historical volatility. 5% daily move. Designed for that, 7% stressful but manageable. 10% outside risk parameters. Uncharted territory. Here's the nightmare. A bullion bank holds significant shorts. Today's move wipes out their capital. Clearinghouse issues margin calls. The bank can't meet them. Clearinghouse liquidates positions, but doing so drives prices higher, creating losses exceeding what the bank can cover. The bank defaults. Clearinghouse absorbs losses from its default fund capital contributed by all members. If losses exceed the fund, Clearinghouse requires all members to contribute additional capital or halts trading. If members refuse, fearing bottomless pit, then interbank lending freezes, credit markets seize. This nearly destroyed the global system in 2008 when Lehman failed. Today's silver move brings us uncomfortably close to similar crisis. The retail awakening. Google searches for how to buy silver have exploded. Social media buzzes with screenshots and shortage discussions. People who viewed precious metals as boring are suddenly paying attention. When markets closed at 79, retail couldn't buy, physical dealers closed. Online platforms locked prices. But awareness spreads rapidly. Monday morning, millions of retail buy orders hit simultaneously. People buying coins, ETFs, futures. This tsunami of demand meets a market already stressed by institutional liquidations and industrial buying. Dealers will respond by widening spreads dramatically. Coins that sold for spot plus $3 might command $10 or $15 premiums. Some dealers will close buy portals, claiming inability to source metal. This is scarcity manifesting at retail level. For those already holding physical silver, this is the wealth transfer moment. Value flows from paper promises to tangible assets. But timing matters. The real gains come from holding through entire repricing. We're not at the peak. We're at the beginning of price discovery in supply-constrained environment. Monday's gap opening. Shanghai opens first among major exchanges. Chinese buyers will have processed today's move over the weekend. Expect enormous buy orders in opening minutes. When Shanghai gaps higher, and it will, that sets the global benchmark. London opens hours later, COMEX follows. Each references previous close, sees silver trading materially higher, and adjusts. A $5 to $10 gap above Friday's close is possible. Maybe likely. That puts us near 85 or 90 at the open. Circuit breakers might trigger immediately. Exchanges halt trading if prices move past certain thresholds in opening minutes. These prevent flash crashes and allow human oversight. But circuit breakers don't reduce demand, they compress it. When trading resumes, pent-up buying releases at once, potentially triggering another halt. Multiple trading halts Monday morning are possible as the system struggles to process the new reality. Volatility will be extreme. $10 hourly swings possible. Your instinct will scream to sell and lock gains. Resist that instinct. Volatility is the price of admission during paradigm shifts. Strategic positioning. This moment requires calm discipline, not panic or greed. First, verify your holdings. If you own paper silver ETF shares, allocated accounts, futures, understand counterparty risk is now real. Some institutions may invoke force majeure and settle in cash rather than deliver metal. If possible, transition to physical ownership. Coins, bars, anything tangible that eliminates counterparty risk. Yes, premiums are high, but premiums are the cost of certainty. Second, reassess your exit strategy. At what price do you swap silver for gold? When do you exchange into real estate? Having predetermined targets prevents emotional decisions during peak volatility. Third, ignore daily noise. If you're checking prices hourly, you're torturing yourself. The macro thesis: currency debasement, supply constraints, industrial demand remains intact regardless of short-term swings. For those entering positions, understand Monday's gap might look expensive but could prove cheap in hindsight. However, leverage is suicide in this environment. Only buy what you can hold through massive volatility. Political response. When silver hits $80, $90, $100, regulators will notice. Headlines will scream about speculation and manipulation. Congressional hearings might be convened. Some will call for intervention, price controls, trading restrictions, investigations. Here's the irony: political intervention validates the scarcity thesis. If governments feel compelled to intervene, it confirms fundamentals are real. Historically, every attempt to control commodity markets through political force accelerated the shift toward physical ownership. Paper markets can be manipulated by decree, but physical metal cannot be conjured by politicians. Political noise will be annoying but ultimately bullish confirmation. Today's 10% surge is not an aberration to dismiss or temporary spike to fade, it's a signal. The old system where paper contracts controlled price discovery despite physical scarcity is collapsing. A new system where actual supply and demand determine value emerges from chaos. We're witnessing forced liquidation, industrial panic buying, and clearinghouse stress simultaneously. Each amplifies the others. Monday's opening will be historic. Gaps, halts, extreme volatility all virtually guaranteed. This isn't the end of silver's rise. This is the beginning of true price discovery in a market suppressed for decades. The old paradigm is dead. The new era where physical assets reclaim their position as stores of real value has arrived. Stay calm, verify holdings, prepare for volatility. Hold your ground, the system just broke. What comes next will be extraordinary.